Hi everyone, what's up? Welcome back to my tutorial channel. It's Daniela here, and today I'm going to talk about uh, the remaining of risk analysis. In the last video, I talked about the scenario analysis, sensitivity analysis. Today I'm going to continue to the Monte Carlo simulation, the decision tree, and the real option. First, Monte Carlo simulation. Remember, the sensitivity analysis and the scenario analysis tell you what would happen to the NPV, the net present value, if one set of parameters change, but can't tell how likely the NPV is. Here we use the Monte Carlo simulation to use the historical data and construct a frequency distribution of NPV. From there, we can estimate the probability of adverse and good outcomes. So the Monte Carlo simulation will give you the frequency probability distribution of the NPV, and we can see how likely the NPV is. And the steps to perform a Monte Carlo simulation as follows. First, we have to model the NPV as a mathematical expression of parameters. Basically, it's just like an equation, a function of a couple parameters. Then we have to specify the Chern distribution of parameters. Since we have a couple of parameters in the model, so we have to have the Chern distribution of these parameters all together. Number 3, we use a computer to draw a scenario of the set of all parameters. Usually when we deal with real life dataset, we have to use computer to run some loop. In IFM, on the exam, we are never asked to run the scenarios from the set of all parameters. This is just give you an idea how Monte Carlo simulation would look like. It's look very much like bootstrap and statistics. Number 4, for each of these scenario, we calculate the future cash flows and the NPV. And we repeat step 3 and 4 a very large number of times, sometimes maybe 1,000, 5,000, 10,000. It's really much like bootstrapped. Number 6, we plot a frequency distribution of resultant NPVs. The mean of the distribution gives the base case NPV of the project, while the spread of the distribution indicates how risky the project is. And here, this Monte Carlo simulation works well for discrete variables, because for discrete datasets, we can list the possible value. Now, market value of a project. The market value of a project is the sum of the NPV of the project without options and the value of the real option implicit the project. Decision tree. To understand the decision tree, which is a diagram representing the real option that exists in the project, let's consider the following example. Consider a project which involves drilling an oil well. The drilling risk costs 300 today, and in 1 year the well is either a success or a fail. If the outcome is success, the present value of the payoff at time 1 would be 575. Otherwise, it would be 0. The outcomes are equally likely. The appropriate effective interest rate is 10% per annum. A. What is the net present value of the project? B. Instead of getting 0, the firm has an option to sell the rig for 250 at time 1 if the project fails. I. Compute NPV of the project taking into account the option of sell the risk. 2. What is the value of the option to sell the risk? So now let's work on this problem. The expected value of payoff at time 1 is 0.5 times 575 plus 0.5 times 0. This is because if the project is success, we have 575, and if the project is 0, we got back 0. And these two events are equally likely, so basically we take weighted average, and here 50% chance for its possibility, so we got 0.5 times 575 and 0.5 times 0. So we got 287.5. So the NPV at time 0 is therefore given by, remember the formula, minus initial investment plus the cash flow time with 1 plus Q to the n over, here we consider 1 year, right? So it's 2 minus 300, this is minus the initial investment. 287 is the cash flow, and the present value of this cash flow is 1.1 because we consider interest. The cost of capital is 0.1. See that? So we got negative 38.64. Given the option to sell the risk, we have the following decision tree. So we see here, we have at the beginning we have two options, either true or do not true. If you drew, that means you have to have the initial investment of $300, so you have to subtract $300. If you do not drew, then there's no activity. The net present value is 0, of course. For the option of drilling the project, we will have either success or fail. So this is two sub events in the event of drilling the project. See that? If success, then the present value is 575. If fail, we have two more options. When it's fail, we have two options. Either we sit on the risk and stare at the empty hole to get 0 present value, or we can sell the risk to get the salvage value of 250. So a tree diagram is a decision tree is basically a diagram with possible events and its probability. Here we see that first, true or do not true. Each of these have the true is negative $300. Do not true, you don't have to pay for anything. So the NPV is 0. And in the true event, we have two more events, success or failure. And in the fail, we have two more events, either sit on the risk or sell the risk for some money. Now, if we consider this diagram, we see that it is obvious that we should exercise the option of sell the risk if the project failed time 1. Right here, if the project failed time 1, if you just sit there and stare at the empty hole, the present value is 0, so you earn nothing. The benefit is 0. But your initial investment is negative $300. So this is a game of fail, right? But if you sell the risk, you got $250. So at this option, we better sell the risk to get salvage value. That's why I said it is obvious that we should exercise the option to sell the risk if the project fails at time 1. So the present value of drilling the projects if the option of setting the risk is abandoned is PV is equal to 0.5 times 575 plus 0.5 times 250, which is 412.5. Here's the thing. Here we only consider the drilling project case, right? And we have two possible outcomes, either success or failure. But in fail, we abandon the possibility of sitting on the ridge and stay at the empty hole. So actually for the fail, we got $250 PV, right? So we have only two possible outcomes: success, PV 575, and fail, we have 250. With equal chains means 50% success, 50% fail. So we take the weighted mean. We got 0.5 times 575 and 0.5 times 250. We got 412.5. Now the revised NPV is minus initial investment, that is minus 300. The initial investment is 300 plus the cash flow over 1.1. That means the present value of the cash flow or cash flows. The cash flows revised here is 412.5. And over a year with cost of capital 0.1, we got the present value for the cash flow is 412.5 over 1.1. And we got the revised NPV is 75. Go back to the beginning. At the beginning, we calculated the NPV should be negative 38.74. Now with this option of dropping, the option of selling the rich, we lift the NPV up to 75. So there's a gap between dropping the option of selling the option of sitting on the rich and the option of not sitting on the rich. So we take 75, subtract negative 38.74. This gap, 113.64, is the value of the option. I repeat, before we dropped the option of sitting on the rich and stay at the empty hole, the net present value was negative 38.74. After we dropped the option, the net present value is 75. So there's a gap of 113.64, and this gap represents the value of options. Now we consider a couple of real options of capital budgeting. The following three real options are commonly seen in capital budgeting. First, the option to expand. If we find a positive NPV project, we should consider the possibility of expanding the project to get a larger NPV. 2. The option to abandon. The option of abandon has a value if demand turns out to be lower than expected. Number 3, timing option. Timing options are viable if the underlying variables are changing with a favorable trend. And here we have some formulas. The earnings before interest and tax is denoted by EBIT, and it is calculated by taking revenues, subtract cash costs, subtract depreciation. Remember, depreciation is the non-cash expenses, right? So we take the revenue, subtract the cost by cash and non-cash. See that? Then the net profit is the earning after taxes. Here we assume tau C is the corporate tax rate. So the net profit is the earning before interest and tax times with 1 subtract tau C. So this is the net profit, or the unlevered net income after taxes. And then we got the free cash flows. FCF is the net profits plus depreciation, subtract capital expenditure, subtract increase in the net working capital. So this is the free cash flow. Alright, so now we are going to do some practice. However, please keep in mind that these practice are just some core examples. In order to have a better practice for the exam, please find and work on more exercises that relate to this topic. Number 1. This is a multiple choice question. The investigation of the impact on NPV of changing multiple parameters is called A. Break-even analysis, B. Sensitivity analysis, C. Decision tree analysis, D. Scenario analysis. E. Monte Carlo simulation. So now let's work over these one by one. Remember the break-even analysis will help us estimate the value of the parameter that can result into zero NPV. So break-even analysis is not the answer. Sensitivity analysis considers the impact on NPV when we change only one parameter while keeping others fit. So B is not the answer. Decision tree analysis gives you uh, the base case of NPV. Consider under couple options and their probabilities. So decision tree analysis is not the answer either. D. Scenario analysis is an analysis that considers the impact on NPV when we change multiple parameters altogether. So D is the right answer. And Monte Carlo simulation will will use historical data to construct the frequency distribution for NPV. So E is not the answer. So here only D is the correct answer. See that? Question number 2. The investigation of the distribution of NPV by drawing scenarios from parameter probability distribution is called A. Break-even analysis, B. Sensitivity analysis, C. Decision tree analysis, D. Scenario, E. Monte Carlo simulation. So here we draw scenarios from parameter probability distribution. This should be Monte Carlo's, right? Monte Carlo simulation. So it should be E. Question number 3. The difference between scenario analysis and sensitivity analysis is that A. Scenario analysis considers the value of multiple parameters for which the NPV is 0, while sensitivity analysis considers the value of each parameter for which NPV is 0. This is wrong. This is break-even analysis. A is break-even because we consider what's the value of the parameters that lead to 0 NPV. So this is break-even analysis. So A is incorrect. Now for B, scenario analysis consider the effect of IRR on NPV. Why sensitivity analysis does not? This is not the main point of the difference between them. So B is incorrect. C. Scenario analysis consider the effect of multiple parameters on IRR. Why sensitivity consider the effects of one single parameters on IRR? This is not exactly the answer because we consider NPV instead of IRR. So C is incorrect. Now for D. Scenario analysis consider the effect of multiple parameters on NPV, while sensitivity considers the effects of one single parameters on NPV. This is correct. So our interest is the NPV, not the IRR. And for scenario analysis, we consider the effect of multiple parameters. Why sensitivity consider the effects of only one single parameter? So D is correct. Now for E, scenario analysis is an alternative name for sensitivity analysis. This is not correct because since a scenario considers multiple parameters while sensitivity considers only one parameter. So D is the correct answer. Number 4. In a Monte Carlo simulation, A. Parameters are assumed to be independent with each other. B. The result of simulation is the mean of the NPV from all simulation runs. C. The effect of parameters that varies in discrete manner cannot be studied. D. The effects of parameters that can vary continuously can be studied. E. The correct answer is not given by A, B, C, or D. So let's consider one by one. First, look at A. Parameters are assumed to be independent with each other. This is correct because this is the reason why we need a Chern distribution. B. The result of simulation is the mean of NPVs from all simulation runs. This is right as the step in performing Monte Carlo's simulation. So B is correct. Now for C, the effect of parameters that vary in discrete manner cannot be studied. This is wrong. We use Monte Carlo simulation is successful with discrete dataset. So C is incorrect. D, the effect of parameters that can vary continuously can be studied. This is not correct because we usually use Monte Carlo simulation for discrete. Number E, the correct answer is not given on A, B, C, D, or D. Here the answer should be A and B. A and B are correct, C and D are incorrect. So E is absolutely correct. Problem 5. We are examining a new project. We expect to sell 9,000 units per year at 35 net cash flow apiece for the next 10 years. In other words, the annual operating cash flow is projected to be 35 times 9,000, which is 350,000. The appropriate effective interest rate is 16%, and the initial investment required is $1,350,000. A. What is the base case NPV? So for A, let's do one by one. The first question, what is the base case for NPV? Remember, NPV is the present value of the cash flow subtract the initial investment. Here we have 10 cash flows at 10 times at time 1, 2, 3, 4, 5, and 10. So we have to find the present value of these 10 cash flows. Then subtract the initial investment. Here at time 1, we got 9,000 times 35. That is the cash flows at time 1. And the present value of it should be 9,000 times 35 times 1 over 1.16 because 16% is the effective interest rate. At time 2, we also have 9,000 times 35 and the present value is 9,000 times 35 times 1 over 1.16 squared and so on for 10 cash flows. Then we subtract the initial investment of 1,350,000 and we got $172,466. There's a base case NPV. Now for B, after the first year, the project can be dismantled and sold for $950,000 if expected sales are revised based on the first year performance. So here we consider attempt 1. Attempt 1, we still have 9 more cash flows. We have cash flow attempt 2, 3, 4, 5, 6, and so on to attempt 10. So first we have to find the present value of the remaining 9 cash flows in order to solve for the level of expected sale. Here we call Q is the break-even sale quantity. We abandon the project if the proceed from the selling equipment is greater than the present value of the future cash flows. Here we set $950,000. The selling price is equal to 35 times what Q. Q here is the break-even sale quantity. And the present value of these 9 cash flows is 1 subtract 1.16 to the negative 9 over 0.16. This is the present value of these 9 cash flows. And from here we have an equation of Q. So go ahead and solve for Q. we got Q should be 5,892.24. So the break-even sale quantity should be 5,892 units per year from the time 1. And part C, explain how 950,000 abandonment value can be viewed as the opportunity cost of keeping the project in 1 year. So if we continue the projects, we have to forego the $950,000 while we can use it for something else. So that's the reason. Alright, so that is all for today. After finish this lesson, the target is to explain the Monte Carlo simulation and decision trees. We should understand the Monte Carlo simulation, how it works, know how a decision tree works and how to compute the NPV based on the decision tree, how to compare the real option. On the projects, we have a couple options, so we have to know how to compare the options. So that's it. That's all for today. Thanks so much for watching my video. I hope you guys enjoy my video. See you on the next time. Bye bye.